The IMF right now doesn't have one debt sustainability framework. It has two. It has one framework for low-income countries and another framework for market access countries. Sri Lanka is just a bit too wealthy, just a bit too high a per capita GDP to fall into the low-income country category. So Sri Lanka is basically one of the poorest countries that is evaluated on the market access country debt sustainability framework. The low-income country framework differs in a number of very, very significant ways from the market access debt sustainability framework. It is more rigid, for sure, allows much less scope for very high levels of debt to GDP. It also focuses primarily on variables related to a country's external debt, that is, debt owed to non-residents, debt owed to China, debt owed to the multilaterals, debt owed to the international bondholders. It doesn't focus as heavily on internal fiscal debt, debt owed to the domestic banks or the domestic pension funds. And for external debt, there are limits on the amount of external debt to GDP, on the amount of external debt relative to exports, on the amount of external debt service relative to revenues, and on the amounts of external debt service relative to exports. There's a final limit on overall debt relative to GDP, which is actually set at a quite low level, around 60% of GDP, which undeniably would have been a major complication for a country like Sri Lanka, which at times, depending on the precise level of GDP, has had domestic debt on its own close to that level. So it's no way would it be easy for Sri Lanka to fit into the low-income country debt sustainability framework. But it does set out relatively clear criteria. For example, external debt to GDP generally should be reduced to between 30 and 40% in a restructuring. External debt service relative to revenues should be around 18%. All of these would imply much more debt relief from external creditors than what Sri Lanka was required to seek under its own DSA. So the market access DSA, debt sustainability analysis, which is a relevant framework for Sri Lanka, uses a fundamentally different model. It's a model that was actually designed not to set targets for debt restructuring, but rather to help the IMF provide fiscal advice to countries with Sri Lanka's levels of income on up to the countries with the levels of income of the United States and Japan. So it is focused entirely, you might say, on fiscal variables, and the relevant debt concept is total public debt. External debt and external reserves simply don't enter into this concept of debt sustainability. And in its medium-term assessment, the IMF concluded, and there's some value in simplicity, that essentially two variables matter. One is the gross financing need relative to the size of the domestic banking system. The gross financing need is the projected fiscal deficit plus the amount of debt that matures and comes due and has to be refinanced. The other variable is the slope of the projected path of debt to GDP. And the only real demand there is that that slope needs to be coming down. For countries like Sri Lanka that have had a crisis or in an IMF program that had a big devaluation several years ago, debt to GDP is almost always forecast to be on a downward trend. So that second variable didn't enter into the calculation. What did enter is the calculation of gross financing need relative to GDP. And the essential argument of the IMF's model is twofold. One, if you have a smaller gross financing need, less need to refinance, smaller fiscal deficits, you can support more debt to GDP. So the relatively low level of Sri Lanka's gross financing need pushed up estimates of Sri Lanka's debt carrying capacity. And the other component is that a big domestic banking system allows a country to support a higher level of debt to GDP. Domestic banks typically roll over domestic debts. They provide a buffer that can help countries absorb shocks. Both are reasonable, debatable propositions. They aren't variables. They're variables that one would normally actually want to consider. But they do seem to have some unusual effects, namely that as a country's domestic banking system increases in size, the overall amount of debt that a country is expected to be able to carry goes up. So because Sri Lanka had a large domestic banking system, the IMF concluded it could support a large amount of external debt. That is, I think, debatable. The other components of this analysis are what it omits. It omits debt to revenue, which has historically been a key issue for Sri Lanka, a very low level of revenue. Now, in general, less revenue means less capacity to support debt, whether domestic or external. And then it simply didn't set out independent limits on how much external debt Sri Lanka could take on relative to GDP or relative to exports. External debt was an omitted variable in the market access DSA. What was included was a separate limit on the gross financing need in foreign currency, which was set at 4.5% of Sri Lanka's GDP. This is significant for a couple of reasons. First reason is that if you look at this as a constraint on external debt service, which is what it became after Sri Lanka restructured domestic debts so that they're no longer denominated in foreign currency, it becomes a 4.5% of GDP constraint on external debt service. If you evaluate that constraint relative to the constraints that emerged on other low-income countries that have been gone through recent restructurings, it allows substantially more external debt service than was allowed in other cases. In Zambia and in Ghana, the relevant variable was 18% of revenue, which works out to being roughly 3.6% of GDP. So to simplify a bit, and there's some variation, Zambia in the low baseline was a little below that, they have a constraint of 3.5% of GDP. Sri Lanka's constraint was 4.5% of GDP, which doesn't sound like a lot, but it allows substantially more scope to construct deals that are favorable to creditors. Also, because this is defined relative to GDP, the more GDP, and in particular dollar GDP, is forecast to go up, the more debt service that's available for private creditors. That was a critical component of the insights that led creditors and bondholders in particular to push for the macro-linked bonds. So to step back, Sri Lanka was judged under the market access debt sustainability framework, not the low-income country debt sustainability framework. Because of some technical features of the market access debt sustainability framework, Sri Lanka is allowed or projected to be able to carry substantially greater debt and pay substantially more debt service, particularly relative to its revenues, than would have been the case had Sri Lanka been judged on the low-income country debt sustainability framework. If you take the 18% of debt service criteria and you apply it to Sri Lanka's projected revenues of 15% of GDP, you actually come up with a debt service envelope that is about half of what Sri Lanka was allowed. And as a result, Sri Lanka, under the IMF's baseline, is projected to be able to return to the market and refinance quite substantial amounts of bond payments and presumably bilateral payments after 2028 at debt levels that are quite high, around 100% of GDP, debt levels at which Sri Lanka has no history of actually being able to sustain, or any evidence that Sri Lanka can borrow in the market at a reasonable rate at these levels. It's a known unknown, but it clearly is a program whose debt sustainability assumptions are on the generous side for creditors and thereby poses large risk for Sri Lanka. On the balance of payments side, it is the case that the program does have a buildup of reserves inside Sri Lanka that should provide a buffer against future distress. Most of those reserves are borrowed from the IMF, but nonetheless, Sri Lanka will emerge from the IMF program, if the IMF program's forecasts are correct, with more than $1 billion, like with a reasonable level of reserves. I forget whether it's 5 or 10 billion, which gives it a little bit of a buffer. It won't be on the edge of literally running out of foreign exchange. So that's positive. On the negative, because the program doesn't constrain external debt or external debt service that heavily, there will be substantial drains on those reserves tied to the refinancing of maturing bonds. And if you think that net external debt is an important variable, that is the total amount of external debt relative to your reserves, well, Sri Lanka, kind of entered into its IMF program with 40 billion of external debt. That's going to go up to 45 thanks to borrowing from the MDBs and IMF, and like 1 billion of reserves. That's a pretty big gap. And you might argue that that would weigh against Sri Lanka's ability to support very high levels of external debt going forward. It's one thing to have 40% of GDP in external debt if you got 20% of GDP in reserves. It is another thing to have 40% of GDP in external debt if you've got 5% of GDP in reserves. Final point is on the macro-linked bonds. So I am not a fan of considering the macro-linked bonds to be a form of contingent instruments. They aren't really contingent. By that, I mean, after the size of the bonds is set in 2028, they don't change. If Sri Lanka has a horrible economic crisis in 2030, there is no bend in the bonds. Sri Lanka faces the debt service profile that emerges at the end of the IMF program. What creates the so-called macro linkage is that the amount of debt and amount of debt service on Sri Lanka's new international bonds is not actually set now at the point of time when there's a framework agreement with the bondholders. Rather, it sets in several years once Sri Lanka's GDP at the end of its program period is clearer. The baseline has Sri Lanka's average GDP over the next few years at around 90 billion, and under that baseline, Sri Lanka would be paying $1 billion, $1.1 billion in foreign currency external debt service on its bonds alone. And the bonds are only about a third of the external debt in 29, 2030, 2031, 2032. If GDP were to be above 100, that goes up to about $1.5, $1.6 billion a year. So the increase is about 450 million. If Sri Lanka's GDP goes up by 10 billion on average. And then if Sri Lanka's GDP falls more like 85 billion, that would be below its current levels, the macro-linked bonds reset down and Sri Lanka gets a 200 million break on its bond debt service payments over those years. So there is some downside protection for Sri Lanka. There's a lot more upside for the bondholders, and that may be an issue with the assessment of comparability of treatment. But to me, the basic concern is that in a context where overall debt levels in the baseline are actually quite elevated, extremely elevated, I would say, the macro-linked bonds provide an extra bonus to the bondholders. And so from a broader point of view, it doesn't seem to me that the bondholders have provided the kind of deep concessions that would normally be associated with these kinds of features. So I do have concerns. I have concerns about the overall level of debt. I have concerns about the level of external debt and the absence of constraints on external debt service that are more binding, and about the particular structure of the macro-linked bonds. Combine that, I do worry that Sri Lanka is being set up to encounter renewed financial trouble 5 years from now.